everyone. This is Andrew Berman, and you are joining us for another NMP webinar. Today, we are going to be doing Diversify and Thrive with Reno and non-QM. Great topics. I mean, to me, these are two huge opportunities, two great niches to get into. And listen, when it comes to renovation, I mean, really, there are few lenders that I would say that are even close to as qualified to talk about, renovation lending as REMN. I mean, these guys just did an unbelievable job of educating brokers. So we're going to go into with them just a couple of housekeeping things. Before we get started here, I'm actually right now taking my cell phone, putting it into mute, and I put it actually over here in my drawer, so I'm not paying attention to it. It's out of mind, out of sight. If you've been with us for one of our webinars before, actually we're going to have you in and out of here inside of an hour. We want to be mindful of your time. It's a busy time in the industry, and I realize how difficult it can be to basically stop to learn new things. I mean, why do you have to learn new things? Everything's great, but this is the time that you need to learn, because it's not going to continue. The party's not going to go on forever. You need to be ready to have actually some diversification in your product portfolio. There's no better way than renovation products and non-QM. So first, before we even get started, I want to see where everyone is. If you've been with me before, I love actually finding out where people are connecting from. So use that question box on the right-hand side. You'll see that question box. Use that question box and write the name of the city and state that you're connecting in. I just want to see where people are connecting in. Just kind of give us an idea. Hopefully, I always hope that people from New York are going to connect. Let's see. Okay, we got Charlotte, North Carolina. We got Beverly Hills. We've got New Jersey. Fantastic. Nice to see the East Coast representing. Pittsburgh, Alexandria, Sacramento. Got Shelton, Connecticut. Area 51. That's great. Gotta love our readers. That's awesome. Springfield, Virginia. Nashville, Tennessee. More people from New Jersey, Kansas City, Chicago, Fort Smith, Arkansas. My mouth is first day with a new mouth here. Let's see, what else we got here? All right, guys, fantastic. So listen, without any further ado, I am going to introduce you to our esteemed panel here. We've got, joining us today, we have Anthony Durso, who is the corporate trainer over at REMN. Anthony, you there with us?
I am here.
Fantastic, Anthony. Thank you so much for joining us. Anthony's kind of the guy that's going to keep us all in line here, make sure we don't get out of hand. We have Steve Rosetta. Steve, you there?
I'm checking in, Andrew. I'm here.
Fantastic. So Steve is going to go into, he's going to do the deep dive into renovation lending, and a long-time friend of mine, a guy who knows I'm 44 years old. He's known me for about 30 years in the industry, Mr. Rob Grosser. Rob, you there?
It's about 35, Andrew, but who's counting?
35.
Bob is present.
That's true. Fantastic. And and Robert's going to go into non-QM. But before we get started here, you guys mind if I just launch this quick poll?
Absolutely. Go for it.
Fantastic. All right, so I want to get a gauge from the people that are on the line right now. What percentage, and let me hit launch over here. So what percentage of your overall business comes from products other than conventional and govies? So right now, if you're looking at this on your screen, if you could please click this, let us know what percentage of your business is coming from products other than standard conventional and government loans. And I'm going to keep this open. Right now, we have about 41% of the room has voted. I'm going to keep this. If you guys get us up to 75%, I'd be a happy man. We're 63%. Come on, keep it coming. I know someone else. What was that?
I'd love 100%.
Oh, we always listen. You know, someone's already actually minimized the screen after hearing my voice. They can go to Calyx Point to get one more loan in for the quarter. So let's see. All right, so we're at 78%. We're going to close this out and see what we got here. Okay, I'm going to share this. All right, do you guys see that on the screen here? What we're looking at?
Yeah, it doesn't strike me as uncommon to see 10% there. I would say that's why we're all here today. 10% is the majority on this poll, which means that, you know, everyone on this poll is really here for the right reason, which is to diversify with non-QM and renovation loans.
And I would say too, I mean, a lot of people at this point, you know what, rates have kind of took a little, little uptick recently, as of the beginning of the month. And, listen, people who've been in the industry for any time at all realize that, you know what, there's actually three things in life that are guaranteed: death, taxes, and eventually interest rates are going to go up. And you know what, this is all about, what do you do when that day comes? So.
Fantastic, great. I'm going to minimize this poll here and hide this away. And all right, fantastic. Take it away, Steve.
All right, thanks, Andrew. And again, everyone, my name is Steve Rosetta. I'm the Renovation Lending Manager here at REMN Wholesale. So we'll talk about first the state of renovations in the nation. And again, I think it was either Rob or Andrew, when we were talking off the call, mentioned there's riches in the niches, right? And that really struck me. And renovation loans are really a niche that, those of you on the call, you can really get into, because I can tell from the poll and from talking to people out in the country that not a lot of people have sunk their teeth into this yet, and the market is still wide open for a specialist in each market. So the goal of today is to get your juices flowing so you can hopefully become that specialist in this niche in your market. But let's talk about the industry as a whole. Spending on home renovations reached a record last year in 2018. That was only up from 2017. And everything we've seen this year in 2019 and the projections for the next few years is that home remodeling is only going to continue. And again, we want you guys to capitalize on that. A couple interesting statistics. The average age of U.S. homes currently is 40 years old or greater, which means that there's a lot of upgrading or modernization that really needs to occur. The younger generation, the new home buyers, the millennials, what they want is state of the art. They want modern. They don't want that 1970s, shag carpet, that old kitchen. They want to modernize it. They want a smart home, right? And we can do these things with renovation loans. And I hear this all the time from real estate agents and mortgage brokers alike, that there's currently a lack of new housing inventory, which means that a lot of people are deciding to stay put in their current homes and improve on what they're already living in and moving less. And what we have as a slogan here at REMN Wholesale is improve versus move. So with shows on HGTV that have taken off over the last 10 years, Fixer Upper with Chip and Joanna or Property Brothers, these shows have really empowered home buyers and homeowners out there to, again, improve on what they currently have versus move. And so what we're trying to do here today is give you the tools to make those HGTV dreams come true. So let's first talk about what is a renovation loan. Well, as you can see from this graphic on the top right, you can either do a purchase or a refinance. So that means we're including the purchase price or the payoff plus the home improvements. And we're doing that all in one single mortgage with one single closing. This is going to be an easy transition for you to get into this niche because you're already familiar with the standard Fannie Mae, FHA, or VA income, asset, and credit underwriting criteria. The only thing that we as REMN Wholesale or other lender that you're dealing with on these types of loans have to teach you is the new rental conditions, right? Contractor docs, after improved appraisal. We can teach you all of that. But it's not really hard to get into. The key with a renovation loan is that you're closing it like you normally would any other type of loan. The renovation work will begin after the closing, after you've gotten paid, after the real estate agent has gotten paid, and you shouldn't be involved in the work at all, which is huge. And whichever lender you decide to go with will handle the contractor draws after closing.
You know, Steve, it's something that is probably an important point to make too with this, and I've seen this as a point of confusion. You know, I know that it's done this way here, and I'm sure it's probably done very similarly at other lenders. The whole contractor aspect of these loans, basically these loans are split up into two pieces. The one half is your standard credit, income, asset, credit underwriting. And the other half is the contractor's piece, but they're not independent of each other in terms of when they're actually worked on. All of this stuff, it's all done simultaneously. Again, I don't know how a lot of other lenders do, and I know here they actually have a separate group that just deals with the renovation piece of it, so that the underwriters, the underwriters is just focused on the regular credit and underwriting that everybody's used to, and then you've got a specialized group that goes and they take care of the renovation piece of it, the contracts, the bids, the vetting out of the contractors, all of that good stuff. So,
that's correct. Yeah. Most lenders have a renovation-specific department that will help you validate the contractor, help you review a bid, help you on your first renovation loan, so that you're not, lost and in the dark.
You're not on your own.
Correct. So that's essentially what a renovation loan is. And why does it give you advantages over, let's say, a cash out home equity loan, hard money loan, personal loan, or credit cards? Well, keep in mind with your cash outs or home equity loans, you're basing the amount you can lend on just the current value or the as-is value of the home. And hard money, personal loans, credit cards, they all have higher interest rates, right? With a renovation loan, however, the loan amount can be significantly higher because we're basing how high we can lend on the after improved value of the home versus as is. So what that means is your appraiser will take the bid in hand and he or she will determine the after improved value. And we can lend based on that value versus what the property currently is.
Yeah, it's an important distinction because if you look at it from this perspective, that these renovation loans, they give you the opportunity to take advantage of value that technically isn't really there yet, which, that may sound kind of a blinding flash of the obvious here, but it's an important distinction when you look at it as compared to other ways to actually finance the improvements or any kind of renovations that you want to do. So
it's a great point, Tony. And in terms of the interest rates, well, now instead of dealing with high, 11 plus interest rates on hard money loans and, up to the 20s and credit card interest rates, we're dealing with Fannie Mae, FHA, VA rates. Right now we're in the low fives. That could change. That could go up or down in the future. But that's why we're here. We're here to diversify with this product. And again, it's not a rate sensitive product, but it is a needs-based product. So if you need renovations on your home or a home you're purchasing, this is the best way to go. And you can finance in those renovations over a fixed rate for 30 years, right? So you have a longer term. And we do, REMN Wholesale and other lenders offer ARM options. So now let's talk about the benefits of renovation loans to all parties. Let's talk about the borrowers first. Well, very simply, you can build equity in a home, right? So if I'm purchasing a home, I'm putting $50,000 in, and I get $100,000 back in value. Look, I just built $50,000 of instant equity You can't really do that with other programs. So borrowers will love you for that. And, once that happens, they're going to refer you to all their friends. Borrowers might also find the perfect neighborhood, but there's no great homes in that neighborhood. Well, now you're giving them the tool to take a beat up property, maybe a foreclosure with a lot of problems, and envision the future after those repairs are done. So now they can live in that perfect neighborhood and build the home of their dreams. And that plays into the real estate agents. You're helping those real estate agents move homes that are less desirable and make them the homes of their home buyers' dreams, right? So you might show up to a listing, and that real estate agent now has a bid showing the potential of the property, showing the new siding, showing the new kitchen. So now instead of your borrower or your home buyer walking away and saying, that's not a good property, now they're looking at the future of what that property could be, and that helps real estate agents move those homes faster. Moving down to the bottom left, we have our contractors, which this is really an untapped source of referrals for you guys. When getting into renovation loans, these are people you should call, if not on your first call, on your second call, because there's a huge list of them in your area. And all they really need is someone to help them out financing their clients' projects, right? So a contractor might write up 10 bids in a week, and only 2 of those people have the proper financing. Well, now with the renovation loan, we can increase that loan amount based on the after improved value and give contractors and their home buyers access to more funds. And again, if you do a great job, these contractors, they might get someone walking through the door, and they might refer you as the preferred source of financing.
It's interesting when I look at it laid out like this, right? And if you think of it from this perspective, once you get yourself, whether you're a broker, you're a lender, right, and you get yourself to the point where you're very proficient at these, you're, in essence, in this whole setup, you're the deal maker, right? You're the one who's making all of this happen. You've got real estate agents that want to sell properties, but you know what, they're distressed. You've got buyers who want to buy properties, but they can't live in them in their present state. You've got contractors who, they want to do a job, they have jobs lined up, but their clients don't have the financing to do it. You as the broker or the lender who's actually doing these loans, and if you're proficient at it, you're the deal maker in this whole thing. You're the hero. In essence, you come off as the hero.
You're the total hero. It's a multiplier effect, and referrals will be coming at you in all ways if everyone in the area knows that you're the man or the woman who can do these loans and can do them the right way.
Yeah, and the other piece of it too is that there are, to my knowledge, in most markets, there are not a lot of people who specialize in this. So you're separating yourself from the crowd just by being there and being well versed in this type of lending.
That's a great point, Tony, and that leads me into the last party, mortgage brokers, which is most of you on the call. This product or these products allow you to differentiate yourself. Again, like we just mentioned, there's not a lot of specialists out there, but we want you to become those specialists. So all those loans come to you. This is also a really great tool to fix appraisal issues. An FHA appraisal comes back and there's 20 grand worth of work to, cure that appraisal, right? Well, you don't have to pass on the deal or kill the deal now. Now you can do a renovation loan, finance in those repairs, and roll it all into one mortgage. And guess what? Those repairs will be done after closing. They don't need to be done prior to. With the increased loan amount, because you're doing additional repairs, that means you'll benefit from increased commissions. Who doesn't like more money? And also, if you're doing a purchase on your first renovation and the rates are, in the right ballpark, you have the potential for a second refi loan. We see a lot of people doing purchases on renovation loans only to refi 6 months later. And again, lastly, do a great job and you're going to get increased referrals from everyone. So now let's talk a little bit about how to source this business, how to get started. The first and most important tip is to search Zillow, Trulia, Redfin, and type in some keywords such as TLC, fixer-upper, as-is, needs work, anything renovation related. And then see those listings that pop up. And then see who the listing agent is. Then reach out to that listing agent and say, hey, I think I have a product or programs that can help you move that home faster, right? And again, you're going to pitch this home as a home that, it's less than ideal, but you can make it a dream home with some renovations that you can help finance. So again, you might get a contractor to write up a proposal and have it laid out, in the kitchen. And the homeowner comes in, they say, look, that's a beautiful new kitchen. I think we'll go with that plan. Or I can envision something similar. So again, it's a great way to get the juices flowing for potential home buyers.
The other neat thing about that too, and taking that approach is, taking it one step further, it's one thing to show, okay, this is what the property can look like, right? Your potential buyer comes in, they see that the home needs a little TLC, things are a little bit beat up, whatever it may be. But to be able to go in and portray, this is what it's going to look like afterwards, and this is what it's going to cost you. It's what it's going to cost you out of pocket, and it's going to cost you every month. And if you can portray that in the right way and show the affordability, which is a key word when it comes to any of this kind of lending, any of these renovation loans, it allows you to get people into homes in a much more affordable manner than if they were going out and buying a property that's completely renovated and the work is all done.
Absolutely correct on that, Tony. Moving on to our next point. Again, we want you to reach out to local contractors. We talked about that a little bit. We also want you to reach out to any past purchasers, right? Or have they increased their family size? Are they in need of a additional square footage for the new baby that they had, right? Do they need a new baby room? Do they need a second floor? Do they need a new pool, right? We can do all that stuff with renovation loan. Again, improve versus move. And on refinances specifically, we have the option for essential zero money down closing, okay, as long as the equity is there. So now let's talk about the specific programs that are out there in the market. You have really 4 or 3 main ones. You have the 203K Limited, the 203K Standard, the Fannie Mae HomeStyle, and the VA Renovation. So what are the differences? Well, on 203Ks, you're really limited to 1 to 4 unit primary residences only. Whereas on HomeStyles, you can do second homes and investment properties. On VA Reno, you can do 100% financing on primaries only, 1 unit. Okay, the 203K, 3.5% down on a purchase, whereas the HomeStyle, you can go up to 97 or 3% down when you stack this with a Home Ready program. VA Reno, 100% financing. Let's talk about some of the differences here. And this might be different at each lender that you deal with. But 203K, just like a 203B, there's MI for the life of the loan. Whereas the HomeStyle, once you reach 80% LTV, there's no MI. Okay. For the most part, HomeStyle is per DU, approved eligible only. And you're going to get better pricing typically on a HomeStyle with higher scores than you would on a 203K, which can, with several lenders, go down to 550 and allow for more flexible underwriting. And a lot of lenders do allow for manual underwrites. A lot of lenders also allow for manual underwrites and scores down to 550 on VA renovation as well. So now let's talk about what you can do with these programs renovation-wise. You can essentially do anything, okay? So I don't want you to get bogged down by the specifics now. You want to talk to your lender, obviously, once you get a deal on the hook, but you can essentially do anything. Roofing, siding, foundation work, appliances. So your borrower wants to buy a new home, remodel the kitchen, and put in all new appliances, you can do that with a renovation loan. Moving over to the right, we can install decks, patios, porches. If you want new fencing, a new driveway, replacing a well or a septic, we can do that with a renovation loan. Now let's talk about a few of the renovations I call that are in the spotlight. Some of these might stand out to you depending on what market you're in. These are a niche within a niche, right? So you might be the garage guru in your area, right? Deal with the contractors that are used to building garages, and you might find a lot of work. You might find a lot of deals. You might find that you become the primary financing option for all the garages in your area. For the most part, most lenders will allow up to the high balance loan limits, whether it be FHA, Fannie Mae, or VA on any of those programs. So that means, again, you can finance in more renovations if we go up to those high balance loan limits. On 203K specifically, you're allowed to do mixed use properties. You just can't do any work on the commercial unit, and we need to make sure that the property is greater than or equal to 51% residential. Manufactured housing, you can do renovations on manufactured housing as long as you're not doing anything structural. Building ADUs, this is really popular out in the West Coast right now, especially in California. A lot of people are getting into building accessory dwelling units, and they have several different names for what they're called. But this is a huge market, and again, you can become the primary financing option for ADUs in your market. We can build them totally from scratch.
And those, see, that's almost like a separate mini home, right?
That's correct.
That's the
like a mother-in-law suite.
Okay. I think I've heard people call them granny flats or something.
Granny
like
flats.
Yeah.
There's several different names, but point is.
So those are like the tiny homes. It's like put a tiny home on my property. Is that kind of like what that could possibly also be?
Exactly. So if you have aging parents, or you have a lot of family, and you need a little side home for them to come stay in or live in.
Your mother-in-law needs a place to live, but you don't want her that close to you. You build her a little house out back.
That sounds great. But by the way, I just want to put this out there. We got some questions coming in. We're not ignoring your questions. We're going to get to as many questions as we can. And if we don't get to everyone's question here, just keep in mind it's either because your question is very, very detailed and something might be a little too specific, or we just we've thought we're going to run out of time. So keep your questions coming in. Use that question box on the right-hand side to queue up your questions, and I'll shut up for a little bit again.
Yeah, you do that, Andrew. All right. Now, so just wrapping up here, building up additional units or a second floor. Again, if you're building your family and you want to improve your home, add extra square footage, living space, again, you could do that with a Reno loan. Solar energy financing, you want to, put solar panels on your home, great. Wind turbines, great. We can do it. Pay off a PACE or HERO loan, we can do that. This is a really cool one. We can finish new construction. So key is a Reno loan is not new construction, but it can help you finish new construction if you're doing a Fannie Mae HomeStyle. So let's say your builder or your borrower runs out of money and they can't finish the home. Well, we can play the hero on that one and finish the home. As long as, it's just the finishing touches, it's 90% or greater completion.
So the work that's already been done on the property, obviously it has to be done in a professional manner, and, we're not going in necessarily and fixing somebody else's.
Correct. We're not starting over. We're not doing anything other than just the last finishing touches. And what's another cool bullet point here is tear downs and rebuilds. You might be in an area where there's, a lot of natural disasters, taking down homes. Well, we can help you rebuild those homes. I know with Hurricane Sandy out here in New Jersey, we helped rebuild a lot of homes. As long as the foundation was intact, we could build from essentially the ground up a brand new home and not get those new construction paperwork docs and high rates and complications. We did it as a rental loan and easy peasy. We also play hero on incomplete projects. Borrowers think that they, can do all the work and finance all the work themselves. They run out of money, and then, whatever lender is doing the renovation loan comes in and plays hero, helps them finance the rest because we can lend off the after improved value. And the last couple points, new pools, huge during the summer months, and do-it-yourself repairs. Okay, this is an option that you want to be careful about because the paperwork can be hefty, but as long as it's done right, and let's say, for example, you have a roof contractor who's also your borrower, and they want to put a new roof on a home, that can be done. But if your borrower is a dentist and they want to put on a second floor, no bueno. And lastly, to wrap this up, let's talk about how you get into this niche for your first loan. Essentially, you don't want to get in over your head. You just want to get the bare minimum, then call your account executive, and they'll hold your hand through the rest of the process. So just get a ballpark idea of the work. Are they putting new siding on? Are they renovating the kitchen? Are they doing foundation work? What are they doing? And also get an estimated dollar amount, whether that's from a live bid or that's just a ballpark number in the borrower's head. Hey, yeah, I'm thinking about doing $20,000 worth of work. That's really all you need to get started. And then once you get those two numbers, you want to get an estimated after improved value. So what the home will be worth after all the renovations have been completed. Once you have all that, call your account executive. They'll help walk you through the numbers. They'll help guide you on how to submit the loan, and you can go from there. And with all that being said, that is my portion of the presentation. I hope you guys enjoyed learning a little bit about renovation loans. I'm going to hand the baton back off to Andrew to introduce Rob.
Great. So, and before we do that, Will Clark wanted to make sure that we know that, let everyone know that there is no EPO and no PPP. So I know what EPO is. What's a PPP?
Prepayment penalty.
Prepayment penalty. Okay. So EPO. Okay. Fantastic. So just letting everyone know about that. So listen, here's the cool thing I love about this. And this is something that you cannot be replaced by fintech. This is like this. There is there's a lot of moving parts of this. There's a lot of variables. There's no app that is going to be able to replace you and stuff like this. This is how you not only technology proof yourself, which, by the way, you need to have all the technology tools in place, but this is the thing that's going to separate you from someone that's just going to be able to do business just solely from an app. And that's what I truly feel that these are the great opportunities for mortgage brokers, which also, the next thing we're going to be talking about with Robert Grosser is non-QM. I mean, non-QM is also another area that we just don't have the ability to address with simple apps. And case in point, so we were just talking about this before we got started here. So I was just at NAM National, and at NAM National, there's an Uber driver. But he was like an elite Uber driver. They call like the Uber Select drivers, which these are like the Uber categories that drive celebrities. Does very, very well for himself. Well, he confided in me that I believe has his mortgage right now was in the 11s or 13s. He's got a hard money mortgage because what did he do? When he went to go get a mortgage, he goes and he keeps hearing there's a company that continues to advertise that it's just very, very easy to just pull up your phone and submit your information and instantly blasts away and gives you a decision. Well, yes, it does in perfect scenarios, but for this Uber driver who's 1099 and has an accountant who's very creative and makes sure that he's not paying too much on taxes, well, he looks like crap to this app that he submitted his information. And then the app told him, hey, until you actually have tax returns that show this income, we can't help you. We can't help you. So I hooked him up with a local mortgage broker in Vegas, and he's going to go through their bank statement program. And I mean, the guy is pleased as anything. So, with that in mind, I'm going to turn this over to you. Robert, you there?
I'm here.
Okay, fantastic. Take it away, and guys, keep the questions coming in. We'll get to as many as we possibly can by the end.
Thank you, Andrew. Appreciate the intro, and a really terrific example of why the QM sector is growing as rapidly as it is. I mean, basically, for the last 10 years post-meltdown, we as mortgage lenders, as mortgage brokers, have lived in a check-the-box environment. It really left so many qualified borrowers unable to get financing simply because they couldn't check the box. So the non-QM product is a suite of products that is enabling qualified homeowners to be in the conventional marketplace today, where the rate differential between conforming rates and non-QM rates have narrowed dramatically. So generally speaking, there are 4 products in most lenders' non-QM suite. There is a full documentation, sort of a Fannie Mae fallout program. There's an asset qualifier where the determination for income qualification is based on the assets that the person has accumulated. There's a bank statement program that's targeting self-employed borrowers, where you're validating income and cash flow utilizing bank statements rather than tax returns. And there's an investor cash flow program that is designed for owners of single-family investment property. And there you're determining income based solely on the cash flow of the property. You know, there's a general misnomer in a lot of folks' minds that non-QM is subprime. It's anything but subprime. Just to give you an example of a recent securitization and the pool characteristics, the average FICO was 730, the average LTV was 66, and the average loan size was $447,000. So these are loans that are designed for qualified borrowers who have alternative means of showing their income and are unable to check the box in order to get a standard agency or a standard jumbo loan.
The other thing too, Rob, and correct me if I'm wrong on this, you know what? Although that's your average, right? Your average in that pool was a 730 credit score. You can still dip down, right, into the 600s. It's just there may be an effect on LTV or some of the qualifications.
That is correct. You actually have lenders, and most of the securitizations will allow for FICOs as low as 580. So again, non-QM is all about compensating factors. It's all about good common sense lending. And that's a very, very important point as we go through these programs, because about 1/3 of the loans that are being made today have some form of exception. So I'm sure that everyone on the phone is experienced, knows a good loan from a bad loan. If you think you have a good loan and there are compensating factors, run it by your lender, run it by your AE, and show them why you think it's a good loan, why you think this loan should be made. And most of those exceptions are getting approved. For the sake of time expediency, I'm going to focus today's presentation on 2 of the 4 programs, the bank statement program and the investor cash flow program. About 80% of the non-QM loans that are being made today fall into those 2 categories. So the asset qualifier and the full doc are great tools to have in your toolbox. But again, we have limited time today, so I really want to give you an in-depth presentation on those 2 programs. So, Tony mentioned in his intro that there were 3 certainties in life there's actually a fourth, which is nothing is forever. And, you know, you look at the rate environment today and you say, this is great. And let's say this rate environment lasts for 1, 2, 3, 4, 5 years. At some point in time, you're going to run out of folks who can refinance. We know that the housing stock is tight. So, and Steve touched on this with the Reno loan. With these loans, you are targeting a needs-based customer, and that's really the strength of the program. So the bank statement program is designed and targets self-employed people. After the meltdown, self-employed borrowers had a really difficult time accessing conventional financing. Before the meltdown, people used the equity in their home to deal with their cash needs, to address seasonality in cash flow. It was an inexpensive source of capital, particularly for small business people. After the meltdown, when they couldn't check the boxes, their access to capital became very limited. And some of the things that you hear about, like advertised on the radio all the time, you know, get a small business loan in 24 hours. They are enormously expensive, those small business loans. Some of those effective rates are in the 30s. So, you know, one of the things we like to talk about is how you source non-QM business. And if you have accountants, financial planners, if you are part of networking groups, I mean, the Andrew story of the Uber driver is so typical. The gig economy is growing. According to the Bureau of Labor Statistics, around 12% of U.S. households derive some form of their income from self-employment. That's 1 in 8. So it's really, it's a big market. You can do loans up to $3.5 million. You can go to 90 LTV. All of the non-QM features have IO available. DTI is up to 50. REMN goes down to 620. Other lenders go a little bit lower, but it gets pretty tough when you go below 620. And again, it's got to be a common, make sense loan. And there are multiple means of qualifying the borrowers.
You know, it's interesting, Rob, too. And one of the things that when you actually lay some of these loans out on paper and you compare them to a lot of the more common, you know, your regular conventional financing and that type of thing, yes, the conventional financing is less expensive. However, it's not an alternative for this kind of a borrower.
That's exactly right.
But when you talk about it in terms of, okay, what's my other opportunity as a borrower? This is heads and tails from an affordability perspective. There's no comparing this to personal loans or some of these other shorter term financing options or hard money options. You're not even close. You're not even in the ballpark.
Exactly. I mean, look, you have shorter term loans, 5-1 ARM, you know, that you're doing with 5 handles on them. So it's a great option. It's a terrific option for someone who might be newly self-employed or relatively newly self-employed, and they look at this as sort of almost like a bridge loan until they can put together 2 years of tax returns. So, you know, targeting is key. It's a huge market. You know, one of the things we like to demonstrate at every webinar are true success stories. And this is something that you guys should utilize with your referral sources, because these are actual loans that have been consummated in unique situations that would not have gotten done if this bank statement program was not available. So it's very, very powerful. I'd like to talk about the investor cash flow program. It's actually my favorite program in the suite. And as Andrew so accurately mentioned, I've been around this space for a very long time. And the single family rental program, the investor cash flow loan product, is one of the greatest opportunities I've seen in a really, really long time. Some little known facts about the 1 to 4 family rental market. Over 50% of all rental units are in the 1 to 4 family category. There are 18 million 1 to 4 family rental units in the USA with over 15.5 million investors. Mostly, listen, there are some big funds that own like thousands of single-family rental homes, but by and large, it's a mom-and-pop, locally operated business where folks own, just a couple. We'll show you that level of detail in the next slide. You can actually use the purchase price and the improvements to qualify to get higher LTVs. It's just a really, really terrific product. And to drill down just a little bit further, if you look at the chart below, and you look at the number of individual investors, so the folks that own 1 to 10 property are by far the largest population of investors. Historically, where were these people getting their financing from? They're either using personal capital or they've gone to hard money. So I like to say there's one thing you're going to hear when you pitch this product and one thing you're not going to hear when you pitch this product. When you have a client who currently has, call it a 10 or 11% hard money loan that's coming due in 2 to 3 months, and you offer them this product with, let's say, a 6 handle as an example, the one thing I guarantee you're not going to hear is Wells Fargo will do it for a quarter less. You will not hear that, I promise you. The second thing you will hear, though, is when can I close? Because you're really bringing value. And as I mentioned earlier, the income underwriting for this loan is simple. It's essentially if the rental income is equal to or greater than the kitty, the loan qualifies. And we have even done, there are ways to do it where the debt service coverage, that's what it's called when you're looking at the rental to the costs. We've done it below 1.0. We can actually qualify using the market rent. So let's say someone has a tenant and that lease is coming due within a year and the appraiser says the market rents are $1,200 and the tenant is paying $1,000, you can use the $1,200 payment, income rather, to qualify. You can also qualify on the IO payment. So this one, I mean, the referral sources are tremendous. One interesting referral source is hard money lenders and fix and flip lenders will actually refer these loans out to you because they want to get paid off. They're short-term lenders. They don't want to be in a transaction for the long haul. They make their money by turning their money. So hard money lenders, fix and flip lenders, again, accountants, financial planners. When you go into a real estate office and you lead with this product, more often than not, someone in the room is going to stand up and say, hey, I own one of those. Do I qualify? So you'll get their attention. You'll open new doors for them. You'll open new doors for yourself. You will distinguish yourself. You will become a subject matter expert. And it is the easiest loan in the world to underwrite from an income perspective. REMN has some great worksheets. A lot of the other lenders have great worksheets. If you are not looking at these programs, you really need to. So with that, I'm actually going to stop so that we leave some time for Q&A.
Fantastic. Robert, thank you so much. Really, really appreciate it. So, all right, we do have a bunch of questions that have come in. I hate to say it, like, they're all renovation questions. So if anyone has any other questions, yeah, please come in. You know what I think it is? I think I really did, and correct me if I'm wrong. I feel like the non-QM stuff is also it's just simple. There's a lot less moving parts. It's just using logic. You're just using can this person do they make money? Forget about actually what we traditionally have had to look at to check those boxes as you were saying, Robert. But do they make money? They have money coming in. Do they control money coming in? If they do, they'll make sure that they pay their mortgage. That's what happens. And without getting too fancy, that's what it seems like. So I see, once people, I think the biggest part with non-QM is you just got to start it. And you start that conversation, because most mortgage brokers are just so used to saying no, 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 which means actually that all of the real estate agents in their community are also used to saying no, 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 no. And it's about reconditioning. So let's go into some of these questions we have here.
Andrew, let me just add one thing. The folks who are most successful in selling non-QM are the folks who target non-QM opportunities, as opposed to looking at the non-QM product as if all else fails, let's see if we can slot them into a non-QM. There is so much opportunity out there, you just have to mine it. And you're not going to be banging your head against the same wall that 12 other loan officers are trying to get through the same door. You will really distinguish yourself.
I got to tell you, Rob, the one thing I love about these two is the old school approach. I know I'm dating myself here, but the old school approach of, get an LOX, let's explain the situation, sell me on why I should be making this loan. If it makes sense, the loan gets paid.
And by the way, the performance of these loans has been stellar.
Really?
For exactly that reason. They're common sense, they're good people, they've accumulated some assets, they have businesses, the performance has been stellar.
That's awesome.
Fantastic. All right, so we're good. Some of these questions here. All right, so do these programs allow for new construction?
Okay, so that's a renovation loan question. The answer to that is no. We can complete new construction on a Fannie Mae HomeStyle if greater than 90%. But the reality is these are renovation loans, so they're for home improvements and repairing homes versus new construction. But we can, on a 203K, also build from the foundation up. And it's kind of a pseudo new construction. Just as long as the foundation, the original foundation is still intact, we can build from the ground up.
Fantastic. All right. Here we go. We got a non-QM question coming in here. Does the investor cash flow allow for a gift of equity? So does the investor cash flow allow for a gift of equity?
So the answer is, and this will highlight what I said before about exceptions, you look at the totality of the transaction. So you're going to look at the LTV, you're going to look at the FICO, and if it all makes sense, then yes, you can have a gift of equity.
Okay, fantastic. Oh, by the way, a couple of people are asking if the presentation will be made available, and yes, we are going to be sending out a copy of the presentation. All right, so do you have a list of contractors in my area?
We absolutely do. So REMN Wholesale and maybe some of your other lenders will have lists. I know REMN Wholesale, we have a list of people that we've validated throughout the country, throughout history of doing renovation loans here. So we can make that available to you. Just email us at webinars@remn.com and request it, and we will send that out to you. And it'll give you a good head start on, maybe suggesting this list to your borrowers or your potential home buyers on where to start to find a contractor.
Fantastic. All right. Great question came in here. Can we use our own contractor on a renovation loan?
Can you use your own contractor? Do you mean, can the contractor be a relative, or can you specify?
Well, let's see if he's going to specify. If he's going to say, but let's say relative, or let's say it's just someone that he uses,
Sure.
yeah. So like
Sure.
if like so it could be doesn't have to be an arm's length. Well, okay, someone you use, someone you're used to working with. That's what the clarification.
Absolutely, absolutely. Just as long as there's no real conflict of interest, you can work with them a ton of times.
They just need to be a licensed, legitimate contractor in the area with experience. That's all.
Exactly.
Okay, so you're saying you can't actually hire people from the parking lot of your local home repair place, and that won't qualify, right?
Correct.
Okay, fantastic. All right, let's see. Next question we're going to go to. We already did ADUs. Can you do ADU with Fannie Mae HomeStyle?
Absolutely. You can even do it with the 203K. Just on a side note, with Fannie Mae HomeStyle in particular, you can do both attached ADUs and detached ADUs. With a 203K, we really want the ADU to be attached to the main structure. But Fannie Mae HomeStyle, it allows for a little bit more in terms of renovations. So Fannie Mae HomeStyle, you can do detached as well.
Okay, awesome, fantastic. All right, well, I don't like to get too much into lender specific, but two people are asking this, so I'm going to ask this. Does REMN have any extra fees for renovation loans?
Actually, we do not. It's just a standard underwriting fee of $8.95. There's no additional fees or discount points. I know a lot of other lenders do charge additional fees. REMN Wholesale does not. Same as any other loan.
Got it. Perfect. All right. So, what if all the contingency fund money is not used?
Great question. So just to highlight what the contingency funds are used for, that's for just in case work. So typically on any renovation deal, we finance in up to 15% of the bid total, just for unforeseen repairs. A contractor goes out there, peels back a wall, sees an extra repair that's needed. We have contingency funds to use to do that repair. If those funds are not used, it'll just go towards a principal reduction and reduce the loan amount. So yeah, they're not essential to be used, but if they're not used, we can reduce the loan amount with the remaining balance.
Okay, fantastic. All right, so next question. Can you pay off other debt to qualify on a renovation? And the same person also wants to know, is there a DTI limit?
So it really depends on the program. This is not a cash out loan, right? You can't do that on a renovation loan, so we cannot do cash out to pay off other debts.
So, okay, so what you're saying, I think, right, is that, and I think this is where the question is geared, is part of the money that you take out, right, part of the money that's being lent can actually go to pay down debt to qualify as well as do home improvements. Is that, and that's not, right, you can't do that.
You can't do that on a renovation loan. You have to do that prior to. And the other question is, there are DTI limits. It's going to vary at each lender. With REMN Wholesale, it's per DU on all programs. We do allow manual underwrites on FHA and VA, however, with overlays.
Fantastic. All right. Can the subject property be sold after a renovation loan, or must it be owner occupied?
Can the subject property be sold after a renovation loan? Absolutely. It absolutely can. It just depends on what timing, but REMN Wholesale is pretty good on not charging the EPO or the recapture fee. You would want to talk to your account executive on that individual scenario before proceeding.
Probably like on a case by case.
Case by case.
Yeah.
Fantastic. Great. And we're gonna do one last question because we're right about at 3 o'clock here. So let's see who's going to be the lucky person to get the last question. By the way, everyone else whose question we're not answering, we will get to your question, or not we, but someone from the REMN team will get back to you. Can closing costs be rolled in on a HomeStyle?
Only on a HomeStyle refinance. So not on a purchase, but on a refinance, as long as the equity is there, meaning the after improved value is high enough, we can roll in closing costs and prepaids, and the borrower can essentially come to the table with no money down. So they can put in a new pool and potentially not bring any money down.
But that's only on a refinance transaction.
Only on a refinance.
Okay, and actually, something I lied, but we'll do one more because I want to know about this. This is selfish. I was curious about this myself. Are you allowed to do work on mixed-use properties?
You absolutely are, but only on the 203K, and it can only be done on the residential units. We also need to make sure that there's the proper percentage of residential. 51% of the property should be residential, needs to be met, and we need light comps in the area to support that mixed-use property. And we also want to see that the commercial business is only light commercial. It can't be, a nightclub or a bar or anything crazy like that, which would affect marketability. But yes, the answer is yes, we can.
Fantastic. Awesome. All right. So listen, we are at 3:01. So we're going to wrap this up. And like I said, everyone who we didn't get to your question, we will get to it. Thank you everyone for participating. We will send out a copy of the recording on this. So if you want to share it with your staff, we'll also send out a copy of the deck. So if you just wanted to have it for notes or anything else. Really, I really appreciate you guys making this happen. Great content, and Tony, Steve, Robert, really appreciate it.
Thanks, Andrew. And thanks everyone for participating. Appreciate the time.
Yep. All right. Stay tuned. We got another webinar coming up next week. Some amazing ones scheduled for the rest of this year. Just like ones that I'm just excited about to be participating in myself. And thank you as always for joining us and taking time out of your day. And that's about it. Everyone have a great day and a great month end. Take care.